Welcome back to the channel. My name is Derek Coffey, and I'm the founder of FWP. And up to this point, all of the content that I've put out has been about setting yourself up for financial independence or retirement. The one thing that we haven't talked about is how you go about protecting that plan. If you think of financial planning as a pyramid, the very base of that pyramid is your cash flow and your net worth. At the very top of that pyramid is the protection aspect. One of those protections is life insurance. And the whole point of life insurance is to protect you and your family in the event that you pass away prematurely. Right now, according to a study done by Bankrate, there are over 100 million people in the US that either have no life insurance at all or are severely underinsured. In this video, we're going to get into the two most common life insurance policies, whole life and term life. And I'm going to show you how you can use both of those policy types to structure your coverage in a way that's going to protect your family in the event you pass away too soon. Stay tuned. Throughout your life insurance needs are going to change. If you get married, if you have a kid, if you purchase a home, any of those life events that occur are going to dictate how much life insurance coverage you actually need. Now, the first place you can look is a whole life policy. And what a whole life policy is it's a permanent insurance. As long as you make your premium payments, then that coverage stays in place. The premiums on a whole life insurance policy are going to remain the same from now until the time you pass away. Now, it can change if you make any changes to the policy, but if you don't make any changes, then that premium payment remains the same. If you're comparing a whole life policy to a term life policy apples to apples, what you're going to notice is the whole life premiums are going to be much more expensive. And the reason this is because that coverage lasts until you pass away. Now, with a whole life policy, there are two components. Component number one is the death benefit, and this is the lump sum amount that your family is going to receive when you pass away. Now, this is a tax-free payment to your beneficiaries, and it can be changed. If you have any loans that are outstanding against your policy, then that's going to affect the amount of death benefit that your family ultimately receives. But if you don't have any loans and you've been making your payments, then whatever coverage amount that you purchased, that's what your beneficiaries are going to receive when you pass away. The second component of a whole life policy is the cash value. Now, cash value acts like a savings account. The insurance company is going to guarantee you a certain interest rate on any of the money that's in the cash value portion of your policy, and it's going to grow tax-free. Now, you can use that money later on in life as a tax-free source of income in retirement or as a pool of funds to pay for your kids' education. But with whole life insurance, you get a lot of flexibility. There's a lot more moving pieces than with a typical term policy. Now, a term policy is just that. It lasts for a set term. It's not permanent like whole life insurance. The premiums on a term life policy remain the same over the course of the term. So as long as you make your payments, your coverage is in place. The difference is at the end of that term, your coverage ends. So if you didn't pass away, then you spent all of that money for nothing. But what you did get was peace of mind. Now, if we compare coverage amounts apples to apples to a whole life policy, the term policy is going to be much cheaper from a premium standpoint, and a lot of this has to do with the fact that the coverage will end. Now, with term life insurance, there is only one component, and it's the death benefit that your beneficiaries are going to receive when you pass away. In most cases, there's not going to be a loan or anything like that outstanding, so whatever coverage you purchased, that's what your beneficiaries are going to receive, and they're going to receive that tax-free. There is no cash value component because this coverage will end. So unlike that whole life policy, there is no savings component to a term life policy. So how much whole life insurance should you have? Well, for me and most of the people that I work with, I want you to have enough to dispose of your body the way that you wish. I want you to have enough to cover all of those final expenses and potentially any probate taxes that your family may experience. So as a bare minimum, I would want you to have at least $25,000 of whole life insurance because this is going to take care of most any funeral arrangement that you would want. Now, if you want a mausoleum, then you may need to get a lot more coverage. But for a cremation or a burial, then $25,000 is going to cover most of that bill. In 2024, the average cost of a cremation is $6,280. The average cost of a burial with a vault is $9,995. So having that $25,000 is going to take care of all of your funeral arrangements. It's going to take care of the flowers. It's going to take care of everything you would want done when you pass away. And then ultimately, there may be a little bit of money left over that's going to take care of the headstone, the plot, etc. But with $25,000, that should be enough whole life insurance to cover your final expenses. With term life insurance, there are typically two options that I work through with my clients. The first one's going to be the more budget friendly of the two because what we're looking to do is pay off debt. So you have your whole life insurance policy that's going to dispose of your body the way that you wish. Now we want to take care of everything else. So what you do, you add up all of your debt. That's the amount of coverage that you need. You look back through all of that debt and figure out which one is going to take the longest to pay off. However many years it's going to take you to pay off that debt, that is your term. So if you look at the example on the screen, if we had a $300,000 mortgage, we had $40,000 on two vehicles and $10,000 between two credit cards, the total amount of coverage that this individual would need is $350,000. We look back through the time remaining on each of those loans, and there's 25 years left on that mortgage. That's the term. So in this situation, you want a 25-year term policy with a coverage amount of $350,000. And what this does is it's going to help your family start anew. It's going to help them get through the grieving process of you passing away, but not be saddled with any of the debt. Option number two is going to be the more expensive option because we're looking to replace your income over that term. So what we first need to understand is how much money do you bring in on an annual basis net? So after taxes, after your 401k contributions, etc., how much money do you bring home on an annual basis? The next thing we need to look at is how long is it going to take to pay off your longest loan, or how long is it going to take to get your youngest child to adulthood? However many years it's going to be to pay off that loan or to get your youngest child to adulthood, we're going to multiply that by the amount of annual net income that you receive. So from the example we just went through, if we took it a step further and we said you made $40,000 a year of net income, still had 25 years left on the mortgage, you still had the vehicle with $15,000 on it, but you had a child that was 8 years old and another child that was 5 years old, you still need a 25-year term policy. This is going to get your kids to adulthood, but it's also going to ensure that the house gets paid off if you pass away. Now, what we're going to do is we're going to take that 25 years and we're going to multiply it by the $40,000 of net income you receive. The total amount of term coverage that you need is $1 million. So how much is all of this life insurance going to cost you? Well, it depends, and it depends on a bunch of different factors. The first of which is the policy type that you use. If you need $100,000 of life insurance coverage and you put it all on a whole life policy, you're going to pay more in premiums for that policy, especially if you compare it to a $100,000 term policy. The second thing that matters when it comes to determining how much it's going to cost you is you. Insurance companies are out to make money. Yes, the products that they provide do offer you protection for your family and your financial plan. But insurance companies need to turn a profit, and they can't turn a profit if they're covering someone who's going to pass away in 6 months. To gauge how risky you are to be insured by that company, they're going to put you through some type of underwriting process. It could be a questionnaire, it could be a visit from a nurse, but either way, you have to go through that underwriting process to get your coverage. Some of the things that they're going to be looking for are your age and your sex. Men typically pass away before women, and older people typically pass away before younger people. So an older male is going to pay more for their life insurance than a younger female. Next, they're going to look at your current health situation. They're going to look at your height and weight. They're going to ask you questions about any pre-existing conditions. Have you had a heart attack? Have you had cancer? Do you have diabetes? All of those things are going to factor into how much you pay. They're also going to want to know about your parents. If your parents had cancer, diabetes, or a heart attack, that's all going to increase your chances of passing away sooner rather than later. If that's the case, you're going to pay more for your life insurance. Next, they're going to ask you about your hobbies. If you do extreme hobbies, then they may not cover you at all. If you go skydiving, bungee jumping, you race cars, they may not want to cover you because there's a higher probability that you're going to pass away. If you're a tobacco user, then you're going to pay more as well. If you smoke or chew or ingest those chemicals in any way, then you're a higher risk for the insurance company. They're also going to ask you about what you do for a living. If you're a firefighter, a police officer, a pilot, all high risk occupations, it's going to cost you more. To give you an idea of how much term life insurance costs, I purchased a 30-year, $300,000 policy about 5 years ago. Now, I'm overweight, I'm a tobacco user, but that policy cost me $103 per month. As long as I make those payments, I have that coverage for the next 25 years. Now, between then and now, my wife and I had our son, so I went back to the life insurance company to figure out how much more coverage I could get and how much it was going to cost me. I looked at a 30-year, $400,000 policy just to make sure that if I passed away, there would be plenty of money to pay off all of our debt and there would be ample funds left over for my wife and my son to carry on. For that 30-year, $400,000 policy, it's going to cost me $184 per month. So for an additional $100,000 in coverage, I'm going to pay an extra $80 per month. Now, nothing's really changed. I've actually lost weight since then. I'm still a tobacco user, but I'm 5 years older. Since I'm 5 years closer to death, I have to pay more for that coverage. Your insurance bills are probably the most annoying bills that you have, maybe second to your tax bill. And a lot of this has to do with the fact that you feel like you're paying for something that you're not getting anything for. But having insurance is very much a damned if you do, damned if you don't situation. If you had it and you never used it, then you feel like you wasted your money. But if you're in a position that you needed it and you didn't have it, you probably wish you would have paid for it. Life insurance is no different. If you pass away unexpectedly in your 30s, 40s, or even 50s, then it's going to blow up everything that you've worked so hard for. And it's also going to saddle your beneficiaries with all of that financial strain. So if you don't have any life insurance, then get some. If you don't want to do it for yourself, then do it for your loved ones. Make sure that they're set in the event that you pass away unexpectedly. I want to thank you so much for tuning in. If this video or any of the other videos that we've put out have provided you value, then hit that subscribe button. If you know someone that doesn't have life insurance, but they really should consider getting it, then send this video to them and help them understand why it's so important. But I thank you so much for tuning in. I'll talk to you soon.